is that regardless of the reason for why it happened, there's a difference of opinion between the two sets of schools of thought. One way or the other, inflation was gone. All right, so after this second Volcker period, and we have, let's go to the data here. Oh, yeah, okay. This has been a miserable period of history. If you look from 1973 down through 1982. But at least the inflation's gone now, okay? And look at the growth of inflation over here. 0.27, negative 1.93. So inflation is nowhere near 9.64, 14.19. So inflation's gone. And what the description says is at this point, firms are like, okay, let's go back and start investing again, all right? So they're now, and there's going to be a big slowdown down here, but they're now thinking, all right, oh, that's very important too. Let me slide it down to that point. They're thinking, all right, now we can get back to business as usual. Now things are settling down. Now we'll go back to a world where we're not looking at double-digit inflation anymore, and we'll increase investment. Now, there are some significant periods of negative investment. Why wasn't there a recession? Look at the government budget numbers. The Reagan administration tripled the national debt. At one point, Reagan was asked in an interview, aren't you worried about the national debt? And he said, no, it's big enough to worry about itself. I said, no, I don't care. And likewise, Cheney said under Bush 2, that Reagan proved that deficits don't matter. So we have, just as similar to the Vietnam War thing, we have this massive increase in the national debt, this massive government deficits year after year after year. They're varying in size, but they're pretty big. And look, by the way, here are these 3 periods of negative investment strung together, and when are the biggest deficits? Right around the same time. All right? So the argument is, hey, there might have been a recession, but they kept spending and it kept the economy going. And so we have this long decline in unemployment, down to 5.33 by the end of the expansion, all right, from 10.37, from the highest it's been since the Great Depression, right? GDP growth, 4.75, which is much healthier than it had been before that. And so what happens next? All right. Desert Storm cycle, which is, I use the name as whatever I called the recession. Inflation finally fell, which is alliterative. Well, the next part is too. Inflation finally fell and firms were ready to invest after the long recession. The first 2 years, very strong. Then there was a sudden dramatic drop. However, the Reagan administration creating very large deficits to offset it. Investment recovered, but not at rates they'd seen earlier. Then there was the invasion of Kuwait in 90, which added uncertainty and a final nail in the coffin. So they said, okay, the economy returned to strong growth, but the Fed had to raise interest rates, and that caused a recession. They're saying, no. This is back to the old days where it's just a saturation in the physical investment, and it would have happened even sooner had it not been for the government deficits. Let's have a look at that. So the endogenous view is saying that investment slows down. And indeed, if you look at these 5 quarters, 4 of them are either negative or 0.14. And so, let me look at the average over here. The average rate of increase in investment in the last year of the expansion was negative 0.57. Meanwhile, it had been positive 907 in all but the last year. And corporate profits slowed. They didn't turn negative. Now, this is the only time really that you see they actually expected things to be worse, but investment's coming down, and they said, look, we would have had, kind of like Vietnam, we should have had a recession earlier. I mean, not that they were in favor of that, but what we did was we held it off by all the government spending. So that's this big, long expansion leading into, when was Desert Storm? I know it's 90, but I can't remember when in 90. This is always challenging because I don't have my glasses on. Desert Storm. August of 1990. Okay. So, losers. All right, now just in case you were unaware of which group came out on the bottom of that one. And, oh, I'm sorry, I should have gone to this little summary thing here for the Desert Storm one. Big increase in investment, large budget deficits, both very important to the expansion. Why did it end? They say because the interest rate was jacked up. The post-Keynesian endogenous view is that no, we saturated the stock of physical capital. Let's have a look. As I showed you, indeed, investment was slowing down. Let's have a look at the federal funds column. Interest rates are actually coming down a little bit. All right, so it's not entirely, although relative to the recent past here, they are higher. So, if you include the entire period, no, these are lower. But actually, if you look at the recent past, there's an argument to be made there that interest rates were higher and that the federal deficit was somewhat smaller. Okay, I'm going to have to go to our actual end of class today, 12:20. All right, now we got the big one. Now, you never saw the TV show Sanford & Son, where Fred Sanford would often call out, "It's the big one, it's the big one," when he's going to have a heart attack when somebody was upsetting him. But here's the big one, the longest expansion in peacetime history. Sorry you didn't graduate then. You can blame your parents for that. And let's see. And of course, as you know, computer technology. It was a steady, if not strong, surge of investment. Finally came to a close in 2000. Fiscal policy was already contractionary, but turned increasingly so. The terrorist attack, the recession was really already underway. But so, what's the exogenous view? Well, we raised interest rates. Plus, there was contractionary fiscal policy. And the endogenous view is going to be, well, actually, we had built up all the physical capital we needed at the time. But there is a big emphasis in the endogenous view of the exogenous impact of those budget surpluses, all right? What drives the expansion? Increasing computer technology. Now, for the exogenous view, what caused the recession? Jacking up the interest rate and the government surplus, all right? Because what do you do when you have a surplus? You tax more than you spend, all right? So I'm draining more income from you than I am pumping back into the macroeconomy. What is the opinion of the endogenous people? They're leaving off the interest rates. Rarely do they think interest rates are really important. They did here because they made them so high, all right, during the Montrose experiment. But for the most part, they're like, interest rates are not that big a deal. So they left that off, but they did include the government budget surplus, which is, of course, an exogenous factor, but this school of thought is nevertheless saying, oh no, you're right about that. The budget surplus has really hurt. And so did the fact that essentially we built all the dot-com companies we needed, and we stopped investing, and so that drives down profits and upsets people. Okay, we're almost to the end of time. Now, well, let's see, I'm sorry, I should take a quick look at this. Okay, where's the investment column? Over here, under growth of investment, up until the last year, the expansion investment grew by about 8.82% per quarter in annual terms. In the last year, there was one really good quarter, which really sort of pulls the average up, but really 3 out of the 4 were pretty crappy. Notice that people still expected things to get better, but profits were falling by the last year. And so that's going to be the endogenous argument. And meanwhile, look at the government spending. All right? Deficit, surplus. These are huge surpluses in here. And so they're going to say, no, we agree with you. The endogenous folks are going to say, no, we agree with you, exogenous folks. Yeah, the budget surpluses were a bad deal. Now, we've got a lot to say about that on Thursday because it's a much more complicated story than that. What about interest rates? Yeah, interest rates are higher. All right, so if I'm a neoclassical Keynesian, I don't have a terrible argument here, all right? That those two columns there look pretty consistent with what I would think, nor does the post-Keynesian one look bad in this case. Okay, last period we've got here. It's going to be, yay, the big one. The subprime crisis, all right? Okay, it was the weakest expansion since 1950, and our expansion since then may have beaten the weak expansion record. But the recession could have started sooner, but consumer spending sort of kept the economy going by raising private debt levels. Now, the exogenous view is, we had interest rates too low, which allowed unwise investments. Then once we did raise the interest rates, it led to a collapse. The endogenous view is investment never really recovered from the first expansion. from the long one. And so it was fueled mostly by consumer spending financed by increasing levels of debt and overvalued equities. And once the default started, interlocking debt structure collapsed, all kinds of bad stuff. So let's look at the data real quick, and then the summary, and then we'll be done. Okay. And you can see here how long the expansion was, which is not terribly long, really. And look at the unemployment rates there are not real impressive. We get it down to, well, 4 something's not terrible. But then we jump back up to, notice these aren't as big as the Volcker recession, though. We don't hit 10. We have like 1 month where it hits 10 or something like that. Rates of GDP growth are really crappy. Look at the investment column. It's unbelievable. 1, 2, 3, 4, 5, 6, 7, 8, 9 consecutive quarters of negative investment. So yeah, it's unprecedented. I mean, other than the Depression. Right. But yeah, I mean, there's a massive collapse in investment. And so what do profits do? They collapse along with it. Now, the exogenous view is we jacked up interest rates, all right? So let's look back at interest rates again while they're here, all right? And indeed, interest rates are higher, all right? And so there is some evidence for that. And the budget deficit is smaller. And let's see, let me go to the summary page now. So we've got the last one. And you know, normally I would have just put up arrow investment on this, but I wanted to point out that during this particular expansion, investment never really got very strong. It never really recovered from the last time. So it was investment, but it was weak investment. So this is still a positive. It's just pointing out that it's not the positive it usually is. And consumer debt really drove demand as well. Then they're going to say that previously low interest rates caused otherwise investments. And then, okay, so what? Well, then the second factor is, well, then they raised the interest rate and they collapsed. They're going to say saturation of capital, rising debt-to-income ratios, and financial fragility, which I'll probably have to explain. Well, you know this one. The financial system collapsed. The rising debt-to-income ratios made the system increasingly fragile, and so when it came down, it pulled everything else down with it. And that's it. That's the United States since 1954. Next time, what I want to do is go into some more detail of specific, and I'll show you here real quick. Next time we do this, we do like, okay, here's the Keynesian view. Here's what they would have predicted, what actually happened, and did it work or not. Anyway, that'll be next time. May the force be with you. Ooh, I get to go watch myself. I'll probably watch my lecture over and over and over tonight.
So you tape the lecture